Corporate finance practice problem using Excel. Convertible bond, pure bond value versus market price, problem number 2. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side, looking at our convertible bonds. Information saying we've got the convertible bonds outstanding. The market price is the $9.45. Remembering that these convertible bonds, meaning we have the bonds that can then be converted into some amount of common stock. The bonds currently selling for $9.45, par value $1,000, coupon rate 9%. They mature in 21 years. We have the conversion price, which is going to help us to calculate then the number of shares that we can convert this into. We'll take a look at that shortly. We have the common stock at market price at the 36, meaning if we were to take the bonds and convert them to the common stock, that common stock is currently traded on the market for $36. The interest rate on bond that are similar but not convertible is yielding 12%. So in other words, if we were to compare this to similar bonds that don't have the conversion feature, we have that 12% rate. So we can look at this and try to value these convertible bonds in a couple different ways. We could look at it from the valuation of the stock if we were to convert, given the fact that the bonds are somewhat complicated because they're not a simple security and we can't compare them as easily to other like securities. So what we can do is say, well, what if we converted them and look at the stock and compare that to something that we know on the market, which is a more simplified security, or we can look at it compared to the bond as if it didn't have the conversion and compare that to like bonds, which once again are a simpler type of security, which there's a set price for. Okay, so we're going to take a look at the conversion value first. So the conversion value, we're going to start off with the conversion ratio, which we're going to back into using the conversion price, which is going to be, tied to the par value. So we'll just calculate that here. We've done this in prior presentations. So if you want to look at the conversion price and the conversion ratio calculations, you can look at that in a prior presentation. But we're going to take the 1,000 par value, divide by the conversion price. That'll give us the conversion ratio, that being the number of shares that we can convert the bond into. So we can take the bond, we can convert it into 26 shares that are valued at the 36. So let's take that 36 here. That's going to be the market price, the common stock market price. So if we were to convert these, we get that 26 shares at the price of the 36. And let's underline that, go into the font group and underline that. That's going to give us our conversion value, which is going to be the 26 shares times the rate of the $36. We got the $9.36. So that's one way we can kind of approach the valuation here. The other side is we can look at the bond side of things. We could say, well, what if we kept it as a bond, compared it to other similar types of bonds? The kind of calculation for the valuation of a bond, as we've seen in prior sections, is going to be the bond value with regards to the interest stream, present valuing it, and the face amount of the bond that we would get at the end, the 1,000, present valuing those two things. If you want to practice that with a lot more detail, go to a prior section where we concentrate simply on bonds, and we'll spend a lot of time with that. If you want practice with the present value calculations using other formats like formulas and tables, as well as the Excel, take a look at a prior section where we focus in on just the present values. Here, we're going to do this fairly quickly here because we've seen this a few times. It's going to be negative present value, shift 9. The rate is going to be what we're going to assume the market rate to be for similar bonds. That would be the yearly rate, but this is semi-annual, so we have to divide it by 2 because we need the 6-month or half-year rate, comma. The number of periods is going to be the 21, but that would be for years, and we need twice that for 6-month or half-year periods, so times 2. And then the payment is going to be the $1,000 for the par value times the coupon rate of the 9%. But once again, that would be the yearly rate, and we need the 6-month or half-year rate, so we'll take that divided by 2. All right, so we get the 685. Now we're going to present value the 1,000, negative present value, shift 9. Rate is going to be that 12% divided by 2, once again, for the half-year rate or 6-month rate. Number of periods is 21, once again, times 2 for the half year, the total number of years, twice that number of year, total number of periods, which is twice the number of years given their 6-month periods, comma, no payment because this is the present value of 1. And so we're going to go to the future value by hitting 2 commas there, and then present value, that $1,000. There's the 87 about, and then use the trusty sum function, SUM, to sum those up. Let's add some pennies. Going to select these 3 cells, go to the number group, add a couple pennies for it, underline the 8650 by going to the font group and underline. So therefore, we would expect then the price, if there were no conversion, to basically be that 771.63. So now we can kind of compare this to the current price. We can say, well, let's look at the conversion premium, which looks at the side as if we were to convert these things to common stock compared to the price, right? So we're going to say, all right, well, what's the bond market price? Let's call it the bond market price is going to be equal to, they're selling for the $9.45. If we were to convert these things to stocks, we know what the stock is currently selling for, which we're saying is the $9.36. So the difference, I'm going to underline this, is going to be the conversion. We're going to call that the conversion premium. That means the $9.45 minus the $9.36. That means that we'd be paying more if we just bought them and then sold them $9 more for them if we were just to convert them at this point in time. Again, of course, we have the option. The whole point is we've got the option to be able to do this in the future, to convert in the future if we so choose. So then let's think about the difference between the pure bond value, if there was no conversion, and the market price. So if I look at the bond market price and compare that to what the pure bond value would be if there was no convertible, looking at similar bonds out there, underlining that font group and underline and look at the difference. I'm just going to call it the difference, would be the 945 minus the 772 gives us the 173. Let's go ahead and select those 3, number group, add a couple decimals. So those are the 2 angles we can kind of look at this. We can say, okay, I don't know what the value is with this conversion feature on the bonds, but I could look at it as if we were to exercise it and then compare that to the market price for the shares that we would have gotten. That's one angle we could look at to try to get at the value of these bonds. Or we can take a look at the bond value as if there was no conversion feature compared to the current price and take a look at that difference to try to get a valuation on the conversion feature. We could also try to think about, okay, well, what would be the actual interest rate on the bonds if there was no conversion feature and the price was at where it is at, meaning we're going to back into the interest rate here using this valuation structure and basically look for the interest rate that would result in the valuation of the current market price of the bonds of the 945, which is another kind of angle that we can take a look at this security from. So I'm just going to do the same calculation here. I'm going to pick up the same values and then I'm going to change it just based on the rate down here. So we'll start off with 12%, the same rate, and then we'll adjust this 12% to whatever rate it needs to be to get to that 945 at the end result, to get this number to 945 instead of the 771.63. So let's go ahead and do that. We're going to say I'm going to do the present value again, negative present value, shift 9. The rate is going to be that 12% divided by 2. Number of periods is going to be then this 21 times 2, comma. The payment is going to be then the 1,000 times the coupon rate of the 9% divided by 2. Same calculation we had over on this side. And hold on, I missed a 2 here, divided by 2. So we should get to the same number, same calculation. And then I'm going to do the same calculation here, present value, shift 9, rate, this 12%, divided by 2, comma, number of periods, 21 times 2, comma, future value, 1,000, and enter. Summing that up equals the trusty SUM, shift 9, picking those 2 up. Let's add some decimals, selecting these 3, go into the number group and add a couple decimals. We're going to put an underline under the 8653 by going to the font group and underline. Now we just want to get this percent then to be whatever it needs to be to get this number, the 771.63, to be the actual market price of the 945. So We could do that manually, changing it to like 11% and so on, or use goal seek. Let's use goal seek. Asking Excel to do that for us. Data group up top or data tab up top. And then the group down here, forecast group. Got to get the termination right, the terms right. So tab in the group, tab, group. That's how it goes. So then we got to set the cell. We want to make this cell, we want to make that be 945 by changing this cell. So we're asking Excel, change this rate to whatever it needs to be to make that cell be what we know it should be, which is the 945. We're going to say okay, and Excel does it for us. So we're going to say, okay, that means that this rate would be the 9.61. Again, if there was no kind of coupon involved within it. And that's another way compared to the 12% for similar bonds that don't have the coupon. So that's another kind of calculation that we might look at to just try to get an angle at this security that's a little bit more complex with that convertible feature on it.